my name is Dana Golden. Today, we're continuing our look at commodity markets, a look at commodity market derivatives, and focusing today on market microstructure and regulation. Market microstructure focuses on how the setup of the market, how the design of the market impacts participant behavior, and regulation focuses on how to deal with the decisions of players that take advantage of the design of the market or flaws in the market design that people might not understand. One thing I think a lot of people in the internet age think is that code is law. What's written down in the website is the code, and that is just the law of the land. That's what happens. You saw this a lot very recently with like a group of people who committed a lot of check fraud. They would take pictures of checks, they would invest it in their Chase mobile app, and then Chase would give them $1,000 because that was right on the check, and then those people would be surprised when they were fined and got arrested and had their bank account seized. Because the truth is, code is not law. Just because the app lets you do that, just because the market lets you do that, doesn't mean that that's according to the rules. Actually, even though it feels like code is law, actually there are regulations on top of what you're allowed to do, what you're able to do, that determine what you're allowed to do. So when you're interacting with any market, you might think, just because I can do this, it feels like I should be able to. But you also have to think about the rules that someone else is enforcing, even if you're able to do it, should you be able to do it. So now, getting back into market microstructure. So commodity markets have traditionally been able to become very unstable. And a big part of the reason for this is the mark-to-market mark-to-margin feature. This is an accounting thing, but how it comes up in futures markets is basically you have a position in a futures market, you're allowed to take on margin in that futures market, and you're allowed to take on to sell a future, buy a future that commits you to if the commodity goes up or down, you're going to actually be able to cover that loss. Basically, if prices move against you, you're able to deal with that. So the accounts are marked to margin daily so that at the end of the day, you always have enough in your account to cover the loss. So if future prices go way up, you can cover it and you don't go bankrupt, leaving the other person holding the futures contract unable to recover. The idea is that if you mark to margin daily, you don't lose the ability to collect because markets just move so far against, and those positions are closed out before a trader has an unsustainable position. But what if this isn't often enough? If commodity prices move quickly in one direction, asset value can become negative, especially when futures positions are leveraged. So if you have a highly leveraged futures position and then commodity markets are moving against you, you can go bankrupt in an hour, which is what happened on the London Metals Exchange last year. If you look it up, there was a pretty significant period where prices for, I think it was nickel, moved way quickly, and then some people went bankrupt. It triggered a circuit breaker, and they actually had to decide we're not going to allow this trading pattern because this was very weird. So yeah, prices move very quickly against you. Suddenly a trader is now overextended and may not be able to pay commitments. And then someone's on the other side of the contract. If you're bankrupt, who's going to pay? Normally you want to get out of these positions, but sometimes you won't. And if you don't, the reason why you might want to get out of this position is because you might go bankrupt. And this is how a short squeeze happens, is suddenly the price is moving too far against your short and you have unlimited upside or a downside risk. So who pays if someone goes bankrupt? Who pays if now you can't pay off the contract? The answer is the exchange. So when you join the exchange and to participate year after year, you have to pay an exchange fee, and then the exchange uses these fees. Part of how it uses it is to ensure that if someone goes bankrupt and you have a trader who can't fulfill their commitments because mark to margin daily was not often enough, the exchange will distribute money to you and make you whole. exchange can also go bankrupt, and that's the real risk here. And this is how, very quickly, if you have fast-moving commodity prices and people going bankrupt, you can have a bankrupting exchange sometimes. So liquidity engines, exchanges obviously don't want to pay for overextension, sometimes can. So they have what's called a liquidity engine. This can lead to liquidity crisis, where you actually saw a lot of commodity exchanges fail this way, and particularly crypto exchanges failed this way recently because they weren't marking to margin often enough. And so that's where the liquidity engine comes in, where you figure out how to make sure someone has enough capital to stop the insolvency. The liquidity engine, the traditional liquidity engine mechanism, is designed to ensure smooth trading and prevent price volatility. It's widely used in stock exchange, commodity markets, and central trading patterns. Basically, you're providing liquidity in the market, ensuring that market players either close up their positions or have the liquidity to sustain them. So order matching systems start off by making sure you're matching buy and sell orders so that the market is liquid enough so if someone needs to get out of a position, they can. We can talk about a little bit the order book, particularly in the case of commodity markets. You have market makers who are large players who provide liquidity by continuously giving buy and sell quotes. You'll often hear about an executing trader. That's what they do. And they profit from a bid-ask spread. So they make a lot of money when prices are very volatile because there's a high bid-ask spread. And they help to reduce price gaps, which lowers the bid-ask spread. So this is one of the main values of speculators, which we talked about earlier on in the class, that they act as market makers. Then, I guess this isn't a speculative activity, it's real market-making activity, but you can act as both, and most people often do. Then you have circuit breakers, where you automatically pause trading or limit trading during major price swings to prevent panic buying or selling. Sometimes the market goes insane, particularly during a short squeeze, where people are worried about where this will end up and whether or not they'll have enough liquidity. So you'll have a limit up or down so that the market can cool down after major news. And then finally, you have clearing houses, which can act as intermediaries to ensure that trades are settled and counterparties fulfill obligations. And this is what we talked about earlier with the mark to margin. They mitigate counterparty risk by making sure every trader is holding enough capital every day to ensure that they don't go bankrupt. And you hope like hell that's enough, because otherwise you're on the hook for it. And then FTX was partially a liquidity engine failure. This is SBF. We've talked about him probably too many times in this class. He set up FTX, which had a liquidity engine which ran, I believe, every 15 minutes. It was a very quick core feature of the FTX. And the idea was we're marking up in a margin very quickly, and that's going to make us safer and less likely to default. It was designed to maintain market stability and present cascading liquidations. FTX also supported the idea that Alameda Research, which was a partner company, was providing liquidity, sort of acting like a market maker. And they did that in a way that was pretty illegal. I think everyone would agree that the way they did it was wrong because they were allowed to... Most players were not allowed to have margin in their accounts, were not allowed to have negative positions. Alameda Research was, and because FTX said that that was not allowed, that became illegal. So FTX liquidity engine, they automatically monitored the margin levels for all user accounts, and then they very quickly liquidated accounts in small increments when they fell below the maintenance margin level. And the idea was, if you do this quickly enough, you can't have markets move too far against someone, and you can't have the exchange responsible for those costs, which will stop FTX from going bankrupt. And I'll tell you in a moment how that worked out. And then you have backup liquidity providers like Alameda Research and some other companies that were there to step in if needed. And they also had cross-margining with the idea that traders could use same collateral across multiple positions. And they also thought they were effectively managing liquidation process and allowing for the prevention of having to socialize the losses. At the time, a lot of people were talking about implementing some of this stuff in broader futures markets like the commodities futures exchange in Chicago, the Chicago Mercantile Exchange. Why did it fail? I mean, first off, there was excessive risk-taking. FTX allowed for far greater leverage than it said it allowed for. There was a far more extensive possibility for exposure to crypto price change than they said there was. There was poor risk containment. The engine could not handle the extreme volatility we're experiencing when they went bankrupt. And also, they just committed a lot of fraud. They pretty obviously committed a lot of fraud. First off, they didn't know what was on their balance sheet. They just didn't have a balance sheet. And then they misplaced $7 billion. And then they let Alameda Research be treated preferentially to bypass normal liquidation protocols, essentially access unlimited credit, which was a big part of why this guy is now in jail. And then customers were unaware that all this was happening. It's not totally illegal to treat your market maker and your liquidity provider preferentially. And FTX argued, well, actually, we weren't bankrupt. We actually were in a liquidity crisis. We were fine long term, but we had a short-term liquidity crisis. I'm sympathetic to that argument, but I'm also very sympathetic to the argument they committed a lot of fraud. So customers were unaware of how their funds were being used and the full extent of risk exposure. They misappropriated customer funds for speculative investments and personal benefits. So now, I think you're probably maybe a little bit confused. Why did I just discuss cryptocurrency? Is that really a commodity? I mean, first I was talking about it in terms of liquidity engine, but actually, this goes to a more philosophical question, which goes back to what we were talking about last lecture, where I said a commodity has these specific definitions, and this is how we traditionally think about commodity in natural resource economics. But there's another definition of commodity, which is the legal definition of commodity, which comes down to who is the regulator and how it should be treated as a regulated asset. So is Bitcoin a commodity? Are stocks commodities? The answer is that there are two different types of regulated assets that we think about in the market. The first one is securities, which are regulated by the more stringent Securities and Exchange Commission in New York City. A security exists when a person invests his money in a common enterprise and is led to expect profits solely from the efforts of a promoter or third party. So I can't stress enough, the definition of security is based on the value of a security being based on someone else's effort. Equities and bonds are like this. Many crypto projects are like this because many crypto projects are not based on the idea that this is just going to go up or down. They're based on the idea that the crypto is based on someone else's efforts. Actually, most crypto projects, though, so the crypto projects that are like this are ICOs or independent coin or additional coin offerings, where someone's saying, "I'm going to provide a service." Bitcoin is most certainly a commodity because it doesn't make any promises that someone's going to make an effort. Commodities are regulated by the more free market-oriented Commodities Futures Trading Commission in Chicago. And common features include interchangeability of a contract. Obviously, like we talked about last time, ag products, livestock, metals, and energy. Swaps, most options on commodities. And then almost all crypto, many crypto projects are relying on someone's effort. Almost all crypto, like Bitcoin and Ethereum, counts as a commodity. I think they prefer that regulation. So you probably are very familiar with the idea of insider trading. What is it? It relies on the fiduciary responsibility to not trade on non-public information. The idea is that you, by taking a position, by holding a position, have a responsibility to someone else to not trade on information you know because of your position. It's fine to have non-public information as a trader as long as you don't violate your fiduciary duty. So if you just know something people don't know because you did a lot of work and you put in the effort and you did your own research, that's fine. That is considered public information because someone else could have done that research. Someone else could have done the work. Someone else could have paid to figure it out. But if you have a fiduciary duty, or if someone else has a fiduciary duty and shares it with you, you become an insider and you can't trade on that information. So if you're doing a merger, you can't trade on the information. If you're a company CEO, you often can't trade on the information. It's very difficult to be an insider in oil because these are deep, liquid markets, and it's not clear who the fiduciary responsibility is to. If you're a CEO, fiduciary responsibility is to your shareholders. If you're an oil trader, the fiduciary responsibility is to the oil market. I mean, it's very hard to be an insider in oil because there's not really clear what being an insider even means. A major exception is trading based on proprietary information gained through your role as a trader. So if you're working at a company like ADM or like Trafigura or like just any of the commodities trading houses, and you learn information as a trader, you can't trade on that. On your personal life, you have to have a Chinese wall there. And then another common exception is government reports. This is called the Eddie Murphy rule because of a very funny and very popular movie called Trading Places. Look it up. It's a great movie. Probably a little bit out of date nowadays, I would say. But basically the idea is if you're working for the USDA, you're working for EI, or you're working for the USGS, and you're writing a report that could move markets, you can't trade on that. Normally, in these government positions, you should stay away from trading these commodities in general, or else you can get in a lot of trouble. This is not legal advice. I cannot stress this enough. This is not legal advice. If you're emailing me at the end of the semester, and saying, Dana, I feel like I've done a lot of work. I feel like I really engaged in the material. I feel like you should look kindly on me. If you email me and you include, by the way, your lesson on market microstructure and regulation was not legal advice, I'll probably be more willing to be kind. Just remember that none of this is legal advice. Internalize that fact. So also you can have the market manipulation in commodity markets. We'll see a lot of this in our electricity market lectures. And this involves non-economic trades. As a general rule, you should never purposefully lose money on one position in order to influence the price of another position. Trades should be either hedged or stand on their own as speculation. You should either hedge a trade, in which case you're using one trade to benefit another, even if you're also taking a physical position or a financial position in a commodity. You should be using the trade to offset your other position in part or in whole, or you should be taking a direct position to speculate based on what you believe. You shouldn't have a trade where you think that trade is going to influence the price of another trade. It's very difficult to prove non-economic trades. What's the difference between stupid and illegal? Normally the way that this happens with a trade is the regular choice, in this case the CFTC, comes to you and says, we see this trade doesn't make any sense, this other trade made a lot of money, I think you did this trade because it would move this other trade. And your standard response to that is, actually, I was an idiot. I thought both of these trades were good. I stand by both these trades. The market moved against me. What was I supposed to do? Sometimes you are doing illegal stuff, but it's very hard to prove you're doing illegal stuff because you're supposed to lose money sometimes. So it's hard to know if the trades were connected or not. In electricity market, this is called gaming. FERC defines gaming as behavior that circumvents or takes unfair advantage of market rules or conditions in a deceptive manner that harms proper functioning of the market and potentially other participants and consumers. Ontario Market Surveillance Panel gives a four-part test: a defect or gap in the market design rules and procedures governing IESO, which is the Independent System Operator, the ISO in Ontario. This is a market defect. This is a flaw in market design. And then you exploited it, and then you made profits or benefits or thought you would, and then you have an expense or disadvantage to the market. This is what I was talking about earlier. Just because you can do something doesn't mean that's allowed, and that's allowed by the rule. Above all, gaming must be inconsistent with supply and demand. You did something that made the market function opposite of how it was supposed to. We're going to leave it here because we've already gone through 20 minutes, and we're going to pick up next time with a look at hedging. Hope you have a great day, and I'll see you next time.